This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jim's picture saying looking for the downloads. Eric, let's start off with just covering crude oil, starting with the EIA inventory.
EIA reported a build of 4.2 million barrels on crude oil, Cushing, Oklahoma building another 1.5 million barrels, gasoline drawing down 2.8 million barrels, distillates drawing down 510,000 barrels, for a net petroleum build of 0.9 million barrels. U.S. production holding steady at 13.3 million barrels. The flat price and the time spreads are seriously out of whack. I've never seen a disparity between flat price and time spreads last this long. It seems to suggest that the financial markets are being suppressed by financial actors who are bearish for whatever set of macro reasons, while physical markets are getting tighter and tighter on supply. Normally, that's super bullish for the flat price. You see the spreads widening into deeper backwardation. It's usually a pretty reliable signal that the flat price will follow and move higher. But that usually happens within a day or two. So far, there's been no reaction on the tape. So I'm not sure what to make of this, but I do know for certain that the physical market is getting tighter. Time spreads don't lie. Why it is that the flat price isn't following? Well, that's anyone's guess. We'll see what happens, but I'm guessing this is more likely to resolve to the upside on flat price than it is to resolve to the downside in the time spreads.
Eric, I get your point that so far there's no reaction on the tape, at least if you're looking for that break to new multi-month highs. But when we step back and look at it, we are trading at the multi-month highs, and every dip has been bought, and we are now going on several weeks of sustained price action above the 50-day moving average. And so we're at a level where even though crude oil hasn't broken out, it's still in very good shape and has all the potential for a breakout. If we did have that breakout to 80 plus, the first logical target would be in the mid 80s, around $85, where the fib retracement zones lie. And so let's see whether the bulls can pull this off. Now, Eric, let's move on to equities. What are your thoughts here?
Well, Louis Vincent Gav's comment that this feels like 1999 all over again really rings true for me. To be sure, the breadth divergences and other signs that we're seeing say that this market is top-heavy and overdue for a sharp downside reversal. But look, as far as I'm concerned, we were right back when we said those exact same things here on MacroVoices, 500 S&P points lower. But the market just kept melting up anyway. The big catalyst for the rally to new all-time highs seems to have been the Fed's dovish pivot. So if Jim's call from the feature interview proves right, it should mean look out below for the stock market once everybody figures out that maybe all of those cuts aren't so certain to happen after all. But we've been proven wrong on so many bearish calls that I've lost count. And when you get to the mania phase of a bull market cycle, anything is possible to the upside. So I have no idea how much upside is left before gravity sets in, but I'm definitely going to be paying attention at 8:30 a.m. on March 12th when the CPI data hits the tape.
All right. I want to get Nick involved in the conversation. Nick, both the S&P 500 and the NASDAQ have been doing relatively well. I want to just know what levels you're watching on both of them.
So on S&P right now, the spot price on SPX is 50.70 approximately. There's a call wall above at 5,100 and a put wall below at 4,500. The implied move for the March 15th monthly OPEX is plus minus 100 points. Therefore, the upper implied move is 51.70 and the lower implied move is 49.70. Right now, key resistance sits at 5,100, key support at 5,000. On the Qs, we have a spot price of approximately 435. We have a call wall above at 440 and a put wall below at 410, previous all-time highs. The implied move for the March 15th monthly OPEX is plus minus 12 points. Therefore, the upper implied move is 447 and the lower implied move is 423. Right now, key resistance sits at 440, the call wall, and key support sits at 410, the previous all-time highs.
All right, Nick, I wanted to dive a little bit deeper into just sizing up this market. Obviously, for numerous weeks, we've been talking about that at some point there's going to be a correction and that the market's overextended on the upside. I wanted to just put a little more context into that and perspective. So on page 5, I have the S&P 500, and it's just showing how the fact that in 120 days, we have now advanced 1,000 S&P points, or 25%. And when we just compare that to, like, for instance, the previous bull advance that we had coming off the October lows, we had a rally that was about 20%. And it lasted about 136 days. And so this is a rally that's now still shorter than the last one, but it's certainly had more velocity on the upside. But inevitably, a market correction starts. And so right now, clearly, as we've just seen the print on the PCE price index, this is not the catalyst for beginning some sort of a correction or pullback. The bulls remain decisively in charge of this trend. Every dip has been bought, and we're still holding decisively above 5,000, which I think is an incredibly important level for the bulls to maintain in order for the uptrend to be able to continue. But we have a scenario where inevitably, once given a trigger, all of the stock renters on the upside will be involved in providing all of the selling that will inevitably drive the correction. And so on page 6, what I wanted to touch on was where that selling will inevitably come from. And so here I have the CTA positioning number from Goldman Sachs, as well as the amount of leverage in the markets. And on a 1-year basis, we're at the 99th percentile of leverage. The CTA positioning is at 5-year highs, and all the vol targeting funds are basically very well leveraged up because the vol has been suppressed for down to such low levels. Inevitably, these people are not buy and hold investors. These are trend followers, and as soon as there's any shift, what they were providing all the buying on the way up, and they will also be providing all of the selling on the way down when they deleverage. And the big question is how long can the bulls make this last, and how far will it go?
Yeah, Patrick, I totally agree. Right now, I think we're pretty overextended with this PCE print this morning, again, with another little pop up to the upside. What I'm looking at on the long side for myself personally is long Russell small caps. So I've been saying that for the past few months, and unfortunately I've been kind of wrong. But now I think I'm actually going to be right, because we're seeing the Russell, that being IWM, handily outperform the S&P and the NASDAQ right now. So if we do push higher, I think we need to see, more breadth increase. And that means small caps push the upside. And also we might see some short covering perhaps in some names that are, lower in quality overall, which would also push the Russell higher as well. Otherwise, for the NASDAQ, I'm not very excited about anything right now. Looking at Apple right now, for example, they just slashed their EV endeavor and they reassigned a lot of their staff to AI, right? So a lot of companies are focusing on AI right now, which makes a lot of sense. It's all the hype, but perhaps this hype is not warranted, because will it drive revenues going forward? Perhaps, but I think we're going to see more so efficiencies in operations by cutting staff, for example, and replacing those staff with AI, which can make current employees more efficient.
All right, Nick, though, I wanted to just touch on 2 more charts, and I wanted to just highlight the parabolic nature of the 2 hottest securities, Bitcoin and NVDA. And what I wanted to simply point out is that we have now entered the parabolic phases of these advances, which is the stage where they just accelerate from pure buying momentum and the FOMO of chasing these things higher because this is the only place where performance is. The thing is what makes me more suspect that we could be approaching a high from a timing perspective is that even though I wouldn't want to predict where the exact high of Bitcoin will come, or whether NVIDIA will or will not hit 900 in the next couple of weeks, but when you're entering these parabolic phases, they usually doesn't take very much time for those upper targets to be achieved and some sort of a swing high to be formed. And so watching these types of securities that were in these little mini bubbles is really important to me, because we want to see when finally the bulls exhaust all of the fuel and there's no marginal buyers and some sort of profit-taking cycle begins, because it probably will be correspond with where the short-term highs in the market will come.
Yeah, Patrick, my thinking here, and again, I'm not a big proponent of Bitcoin. Like, I do own some Clean Spark, for example, and I own a little bit of Bitcoin myself, but I'm not a big proponent of it, is that everyone knows the halving is coming, which is why we're seeing this massive run. So if everyone's front running this event, in all probability, we might see a sell-off after the event itself.
All right, Nick, let's move on to the volatility index on page 9. Now, we are a little bit higher off of the December-January lows, but we still don't have any meaningful rises in volatility yet. That nervousness simply has not materialized yet. What levels are you watching on the VIX here?
On the VIX right now, with a current level of approximately 14, this would denote intraday moves of top to bottom of about 0.75% roughly. Right now, looking at the high level of around 16-ish, that's where I would look for a possible breakout toward 20. But again, we need some kind of exogenous risk event for that to occur, because right now what we're seeing is we're seeing a lot of selling of both put options on downside moves and call options out of the money on upside moves. So we're seeing kind of, markets up, vol up. But then what's happening is that we're seeing participants take advantage of that by selling out of the money calls on that move up, in the same way that participants sell puts on the move down as well. So a lot of this selling is suppressing the intraday moves, keeping us in tighter ranges than usual. And we're seeing these intraday moves of about 0.62% top to bottom, which is actually lower than the intraday move denoted by the VIX itself. Now, moving on to page 10, we have the US dollar index. Eric, what are your thoughts here?
104 is a critical technical level, and we're teetering right on top of it. To my eye, the technicals are ambiguous. I could make a technical argument in either direction. If Jim Bianco is right on inflation, a higher dollar is probably in the cards, and if it goes a lot higher, that could break a lot of things. But I think it's too early to call this market either way.
Well, Eric, I'm just keeping it super simple. As you can see on page 10, I just put that 50-day moving average, and the dollar index basically, once breaking above that 50-day back in January, has been more or less consolidating along it. While the slope hasn't risen much and we haven't seen the breakout, at this stage, I think that the dollar's still in half-decent shape for a potential bull breakout. So let's see whether the bulls can make that punch above the 104.50 level and actually hold it this time.
Now, next we have the gold futures chart on page 11. What are you guys thinking here?
I took the topping pattern in the slow stochastics as an opportunity to cut my exposure to long gold futures in half over the past week, getting out of half of my position in the mid-2040s. I'm still super duper bullish on gold long term. But if Jim's proven right, and I think the odds of that are better than 50-50, I think we probably have a test of 1922 or lower coming. And if that happens, I want to have plenty of dry powder to buy it in size.
Well, Eric, gold has been consolidating now for 2+ months, and we have seen this consolidation come and test the 2000 level. Now you can just connect a trend line along all the highs, which happens to correspond with that 50-day moving average that I kept on there as well. And more or less it lines up in this 2050 area. And to me, it's super simple. We're going to use this as a pivot level. If the gold trade stays at 2050 or less and then breaks back down, then the correction isn't over. But I'm looking for any sustained period above 2050, because that would start repairing the chart and making the price action look more constructive, which may start attracting buyers. Let's see whether or not the gold bulls show up.
Eric, it's been quite a correction on this uranium dip. What are your thoughts here?
I think the correction we've seen in uranium and uranium miners is ending, with the caveat that month-end effects could easily lead to one last push lower on Thursday, the day this podcast will be released. Our good friend Justin Hune over at uraniuminsider.com put out an excellent subscribers-only video on Sunday laying out his hypothesis for exactly what caused this sell-off and when and why he expects it to end. Out of respect for Justin's other paying subscribers, obviously I can't can't share those details on the podcast. But suffice it to say, Justin isn't telling his subscribers to sell anything here. So I think uranium and uranium miners are a strong buy here, but my one big caveat is that just like junior gold miners used to be, uranium mining shares have a very high retail participation and relatively low institutional participation. Look, there's no nice way to say this, but retail investors are famous for rushing in at the tops for fear of missing out and then panic selling at the bottoms out of fear of losses. So if Jim's inflation call proves right, and the broader stock market enters a deep correction, I think it could bring an even deeper correction in uranium mining shares, purely because of that retail panic factor. For that reason, I think the metal is safer than the miners here, and if we get another hot inflation print, I'll definitely be putting my S&P hedges back on. The short, medium, and long-term fundamentals for uranium couldn't possibly be better, but investor sentiment trumps fundamentals, and like I said, uranium miners are volatile issues because of their heavy retail participation.
Eric, it does make sense for this to be a buy on dip. The fundamental story that's been driving uranium hasn't really changed. And so inevitably, like what will happen with the stock markets, uranium just went through a profit-taking cycle. These things happen in these market cycles, and it's very reasonable to assume that this will present that buying opportunity.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.